Good afternoon, everybody, and thank you for attending both live and virtually. This is Mark Salter. I'm the Executive Director for the CFA Society of Minnesota. I am coming to you live from Sioux Falls, South Dakota, where we're in front of a huge crowd of one right now, but we're expecting a couple more. And the rest of you are all on screen. Hearing all of this. So thank you very much for putting up with the slight delay. We wanted to use this as an opportunity to figure out how to do a hybrid meeting, a combination of live and virtual, because we know going forward, as we all get back to some sense of normalcy, there will still be folks who will want to attend virtually. So thank you very much for putting up with the technical issues. And with that, we will get started. I'm going to talk for just a minute or so. I'm going to ask Megan to flip forward one slide so that we can say a thank you to our annual sponsors. All the firms you see on the screen are folks who generously contribute of their time and talent and treasure every year so that we can do things like this and figure out how we can do combinations of virtual and live events. So we thank all of them. And if you are one of them attending today, thank you specifically. One more slide forward. We also want to give a shout out to our good friends and partners at CFA Institute. Back a year ago when the world was going to heck, they reached out and said, would you guys like to have a licensed Zoom meeting so that you can continue doing all of the professional learning stuff that you've been doing? We said, yes, please, thank you very much. And so we always want to give them a thank you when we do something like this. I will then, Megan, go ahead and stop sharing my screen so that our good friends from,
Bitwise.
There we go. Yes, we will let them talk now so that I will get out of the way. I had planned to do the Q&A, but I'm a little leery about doing that. So I'm going to turn that over to our buddy John from Bitwise. He's going to introduce our speaker today, Matt Hougan. And we wanted to thank Matt and Bitwise and those folks for sending us a bunch of hard copies of this marvelous publication that just came through from CFA Institute. You can come to Sioux Falls and pick up your copy if you want. Otherwise, we'll send information on how you can download a PDF from the Institute's website. So with that, I'm going to mute myself, turn off my camera, and turn it over to John and Matt. And thank you guys very much.
Mark, thank you very much. Really appreciate it. I'll start off very quickly before we pass it over to Matt. And again, just want to thank the CFA Institute, specifically this chapter, helping us organize this. And from my understanding, getting record attendance, which has quickly become a major topic in the financial services industry, which is cryptocurrency and the crypto asset class. So we're excited to be here. Mark obviously held up the research brief that was recently published and co-authored by Matt, our featured speaker. Again, if you have any troubles getting a copy of that, please work with Megan, work through Mark, and we'll be happy to send that out to you. Matt, if you want to go ahead and we'll jump into the agenda, just share a little bit about what to expect on this call, right? So first and foremost, like Mark was alluding to, who is Bitwise, right? What is crypto? Crossing the chasm in 2021. We're going to look at some of the data-driven analysis and figure out why does that even matter. And we're going to think about crypto in a portfolio. And then obviously at the end of the call, open it up for Q&A. And I'll do my best to answer those, as Mark alluded to, in the chat. So if you have a question, please type that message in the chat. We'll try to get through everyone's questions as best possible. And then obviously maybe follow up afterwards if we can't get to everybody. Matt, please. So who is Bitwise, right? So Bitwise has become, in my opinion, the go-to resource for financial professionals looking to get educated and accessing the cryptocurrency space. we've created the first and largest cryptocurrency index fund. Actually, Matt, I think we might have to update these numbers because we had crossed $1 billion here. The money is moving up quickly. So we are actually now north of $1 billion in assets. We're well known in the industry for our research. Obviously, as many of you know, publishing the first ever research brief for the CFA Institute on crypto assets, which we're going to be highlighting some of those findings today. One other thing that kind of separates us is we're advisor focused. We are solely focused on partnering with financial professionals, helping them get educated, and again, accessing that space because we understand it's a new asset class. It's quickly emerging. Not a day goes by where we don't see other headline news around the crypto space, and it's hard to navigate with your clients, and we're here as a resource for you. And we want to make sure that we're bringing our experienced team. Again, Matt might need to update this slide because I think we went from 13 to 20 here in the last couple of weeks as we continue to grow. But we want to be the thought leaders in the space. We want to be the partners of the financial professionals, and we're backed by some of the most widely known firms in the world. Matt, please. So just a quick run through on some of the executive team. Hunter Horsley, CEO, founding the firm back in 2017 with Hong Kim, coming out of the tech space, Facebook, Instagram, was awarded the 30 under 30. Teddy Fasaro, the president, coming from firms like Goldman Sachs, Index IQ, more recently a portfolio manager at Direxion. Mick McLaughlin, 20 plus years in the ETF industry space, coming out of iShares originally. Many of you may know him from his time at Deutsche Bank, helping them bring assets from $0 to $20+ billion. And then obviously our feature speaker, Matt Hogan, our CIO, formerly the CEO of ETF.com and Inside ETFs, columnist for Forbes. We were talking about the guide to Bitcoin and blockchain here with the CFA research piece, but also authored the CFA Institute's comprehensive guide to ETFs. And I don't want to forget to mention here, more recently, being a nominee for a Lifetime Achievement Award in the ETF industry. So we want to congratulate Matt on that nomination because I don't think that's small potatoes. So congratulations on that, Matt, as well.
Thank you, John.
And then obviously the highly quality educational materials. Many people originally looking to us for our original white paper on how crypto fits into an institutional portfolio. And then what I think and arguably is the best written piece for anyone looking to get educated. I think this is a prerequisite for anyone that wants to take it to that next level. I continually hear that from my clients and advisors that I speak to. It is by far the best piece. So if you haven't read through it, please work with Megan and Mark, get a hard copy. It is downloadable on the CFA research site. And I do think it's the best starting point. So next slide, please, Matt. And then of course, the business development team, like I said, we're focused. So I'm John Steck. I'm the business development officer for the Midwest. If you want to get followed up, I know not everyone wants to share the attendance report with the wholesaling or asset management firms, but if you want to have a conversation after this, work with Megan, work with Mark, please indicate that you'd like some follow-up, and I'd be more than happy to take this conversation to another level. And then very quickly, and I promise you, we're not going to talk about product, but the index is available. The ticker is BITW. It is the large cap 10, holds the 10 largest cryptocurrency tokens. It's what we're most well known for. Go ahead, Matt. And then obviously a Bitcoin fund solely. So we do see demand for both Bitcoin, Ethereum, and then even more recently, a decentralized finance, which might be that 200 and 300 level course as we see folks seeking out the bleeding edge of crypto and trying to really allocate assets to a specific sector as opposed to broadly investing in something like our flagship fund. So happy to talk through with those at another time. Matt, I'll pass it off to you. Thank you.
All right. Thanks, John. Thanks, everyone, for spending this hour with us. I make John run through all that about Bitwise so that I can talk about the fun stuff like what is crypto. This is a very auspicious day to be talking about crypto because Bitcoin just traded over $60,000 towards a new all-time high. It's emerging as an institutional asset class. Just yesterday, Morgan Stanley announced that they're going to be allowing their advisors to invest in Bitcoin. And so we're at a very important moment for core education. And I want to extend my and John's sincere appreciation to the CFA Society of Minnesota for organizing this great event. I'm going to start at the very basics. So I'm going to assume on this call that there are people who know a lot about crypto, probably more than me, and people who know nothing about crypto. What I'm going to try to do is frame how I think about crypto, how I think it's valuable to think about crypto, why it matters, and then we'll talk about it as an investment. But let's start with this core question: what is crypto? If there's one slide you take away from this presentation, I want it to be this one. Crypto is not about paying for your mocha frappuccino or whatever your order is at Starbucks. I think there are a lot of people who are very skeptical of Bitcoin, very skeptical of cryptocurrencies because of that word cryptocurrency. They hear that it's a currency and they imagine using it in the same way that we use dollars to go buy our coffee. I'm here to tell you that it could be many years to never before you buy your mocha frappuccino with Bitcoin. Cash works really well for that. But that doesn't mean that crypto isn't interesting. What I want to do today is talk to you about why you should stop thinking about Bitcoin and other crypto assets as cryptocurrencies and start thinking about them as technologies that bring money into the internet era. Now, I'm going to give you a few examples of what I mean, because this is the key to understanding everything that crypto is, everything that it might be, the risks and the opportunities that attend the asset class. This diagram is my first shot on that goal. If I were to send John $10,000 today, what I would do is I would write a check and I would mail it to him. And thanks to the glories of the US Postal Service, he'd probably get that check in 4 or 5 days. He'd deposit it at his bank in Chicago. His bank would then talk to my bank here in the Bay Area. His bank would make sure that my account had $10,000 on it, that it wasn't overdrawn, that I hadn't written 5 or 6 checks on the same account. And eventually, a few days later, he'd be able to withdraw that $10,000. Crypto, one of the ways to conceptualize it is that it allows money to move in the same way that email or text messages move. In other words, instead of this circuitous process whereby I get $10,000 to John, I could just text him money. He can have it in the next second or so. It does much more than that, but that's a good entry point. Now, I know what all of you are thinking because I've done this presentation before. You're all thinking, hey, Matt, what about Venmo? I can already do that with my cell phone. The reason we love Venmo, the whole reason that exists, the reason there are 200 million Venmo downloads in the US is because it allows us to send 20 bucks or 50 bucks or 100 bucks to our friend, and it gets there immediately versus the pain of going on bill pay and writing a check and having it be sent and having to deposit it and waiting for the check to clear. Venmo is useful and thought of well in the world because money moves inside Venmo at internet speeds, at the speeds we're used to. Now, why is that? Well, it's actually very simple. Inside Venmo, you can only send money to another Venmo client, and Venmo processes every transaction that they have. So when I go in my Venmo account and try to send John 100 bucks, Venmo can look, make sure I have 100 bucks, and it knows I haven't sent it to anyone else. So for them, transferring that money is as easy as changing one line in Excel. If you contrast that with the traditional financial system, it's 1,000 different databases all floating around. John's bank in Chicago doesn't know what my bank here in Berkeley, California has, can't look into my account. And therefore, there's this process of trust and verification, which is what makes money move today at analog speeds, what makes it move at the speed of, say, files in manila envelopes in the 1950s. In other words, one database is fast, multiple databases slow. Here is everything you need to know about why crypto and blockchain is interesting, why it's not just made up fairy unicorn internet money that appeared out of nowhere and is now worth $1 trillion. The Bitcoin blockchain, the first blockchain, and all subsequent blockchains that followed on it was not just created out of thin air. There was 30 years of computer science development. There was massive advances in cryptography, massive advances in game theory, and the Bitcoin whitepaper put it all together. It was a legitimate computer science breakthrough that solved a key problem that had existed in the literature for 20, 30 years. And what it did was it created the first database in the history of mankind that's available everywhere in the world, that everyone can see, but that no single party controls. In other words, any person in the world right now can download a Bitcoin client and see the exact state of that database in the same way that Venmo can look in and see the exact state of the database inside Venmo. The difference is that while Venmo is controlled by a single company and open only to Venmo clients, the Bitcoin blockchain and subsequent blockchains are like the internet. They're available to everyone and they're not controlled by any single entity. That's the Bitcoin blockchain. Now, and all blockchains. This is the fundamental root source of why blockchain technology is interesting. Now, why does that matter? You're wondering, great, Matt, they created a new database. It's the first database that's available everywhere that anyone can see, but that no one controls. Why is that important? And it's important because it does three things that have never been possible in the history of people. And each of these things addresses, I would argue, a multi-trillion-dollar market. So what are those three things? The first thing, actually the most trivial thing, but it's still very interesting, is that it allows for an exponential increase in settlement speed of financial goods. That's another way of saying it moves money and financial goods onto the internet. And let me give you an example of what I mean. If you go to Bank of America's international wire page today and you say, I want to send $10,000 to London, it says on their advertising page that it takes 2 business days and that the fee is between 1% and 4%. In other words, if I were to decide today that I want to send money to London, the earliest it can get there through Bank of America is on Monday. Now, Bank of America has 240,000 employees. It has offices in 38 countries around the world. It has $4 trillion on its balance sheet. It has a giant tech team, has a well-paid CEO, and it takes them 5 days to move money to London. By contrast, the other day on the Bitcoin blockchain, someone sent $1.1 billion. It settled in 10 minutes. They sent it at night, and the fee was 57 cents. So when you want to think about why this crypto, why this blockchain stuff is interesting, just remember that example. The world's largest bank, 240,000 employees, offices in 38 countries, takes 5 days to move $10,000 to London. A software network with no employees, no balance sheet, no CEO is able to move $1 billion in 10 minutes for a fee of 57 cents. And it's not just money. Any financial good that we have today takes a long time to settle, right? Stocks settle T+2. Not that long ago, it was T+3. It's ridiculous in an age where we can pick up our phone, watch any movie that's ever existed, read any book that's ever been written, have a live hybrid conference call to discuss this technology, and it takes 2 days to settle stocks. One of the things that this crypto enables is the exponential increase in settlement speed. And the reason is what I told you earlier. It's the first database that's available everywhere, single database like Venmo, except it's open to everyone and no one controls it. So it can move any financial good. And that's it. That's the first thing that blockchains enable. The second thing, maybe the more interesting thing, although possibly not the most interesting thing, the second thing that you can do once you move money onto the internet, once it can move in the same way that text messages do, once it's native to the internet, which blockchains enable, you can actually program money in the same way that you can program software. And one of the things that's interesting about the world is while software and automation has disrupted huge chunks of our economy, it's disrupted retail, it's disrupted media, it's disrupted advertising, it's disrupted manufacturing. Financial services has been relatively untouched. And if you start to think about what a lot of financial services provide, it's really just trust for if-then statements. So for instance, you think about an escrow agent. All an escrow agent does is sit in the middle of a transaction between two people who don't know each other and wait for them to say, upload money and upload the rights to a property. And then they cross that transaction. And for that, they charge a fee. Once you can program money, that's a relatively trivial programming solution. It's called a smart contract or decentralized finance. And instead of hiring an escrow agent to sit in the middle of transactions, you can actually have the software handle that transaction with perfect trust. And the fee, again, is pennies and not thousands of dollars per hour. This area of programmable money is the fastest growing corner of crypto. It's called decentralized finance. You're seeing people build software programs to disrupt market making, to disrupt lending, to disrupt insurance, to disrupt almost every financial services technology. And this space has gone from about a $0 market a year ago to a $50 billion market today. I live in Silicon Valley. It's the single fastest growing thing I have ever experienced. The third thing, though, maybe the most fundamental thing that you get when you have the first database that's available everywhere, but with no single party controls, is you get the creation of digital scarcity, or more profoundly, the creation of digital property rights. Why is that? One of the things about digital goods is that they're just strings of letters and numbers. And my kids, my 7-year-old, can do Control-C, Control-V on his keyboard and create 1,000 copies of any string of numbers in a matter of seconds. The reason we've never had digital scarcity or digital property rights in the past is it's easy to exactly replicate any digital thing. It's trivial. Once you have a database that everyone agrees is true, but no one single party controls, you're actually able to own something without anyone giving you their blessing. You can own a digital good in the same way that I own this phone, or you might own a Picasso on the wall. I'm sure you saw that Christie's recently sold a $69 million digital artwork. The reason it was able to sell that, and we can debate whether it's worth $69 million or not, I'm not sure it is, but the reason it was able to sell that was because you can now own a digital good in the same way that you could own a Basquiat or a Monet. You can be the sole possessor without any third party overseeing it. Now, we talk a lot about crypto's strong performance, right? Crypto is the best performing asset class in the world this year. This slide's through February 26th, but it's up significantly more since then. I would guess Bitcoin's up close to 80, 90% this year. It was the best performing asset class in the world last year, up over 300%. It was the best performing asset class in 2019, with a significantly stronger return than stocks, bonds, gold, oil, etc. It's been the best performing asset class since 2017. It's up nearly 5,000% since 2017. And it's been significantly resilient. So unlike things like tulip bubbles, which emerge and then fall and never come back, one thing that's been true about crypto since it was created 12 years ago is that while it's had significant volatility and it's had 70% plus drawdowns, every time it's gone on to make new all-time highs. It hasn't been the same thing as a tulip bubble. It's incredibly resilient. It's had 6 major drawbacks since 2017 alone, including an 83% drawback in 2018. And yet it's up 5,000%. And if we go back even further, since it launched, the asset class is up 43 million percent, which is obviously a ridiculous number. It's now a $1.5 trillion, verging on $2 trillion asset class. And people ask me why. Why is this idea, which can seem so ephemeral, this internet money, which you can't touch or feel, why is it an asset class that's up 43 million percent? Why has it been so incredibly resilient? And the reason is you have to get away from thinking of it as a currency. It's a technological breakthrough of a scale that's really rare. If you're old like me, I have some gray hair. I remember when the internet was terrible. I, in fact, remember when all you could do with the internet is send someone a file over it. Some of you might remember FTPing people things. FTP stood for File Transfer Protocol, and we used to think it was really cool to FTP someone a file. What a breakthrough. Over the years, people have figured out how to use the internet for different things. In 1982, we figured out how to send text over the internet. That allowed AOL and CompuServe to create email. In 1989, we figured out how to send linked text over the internet. That's HTTP. You've probably seen that at the beginning of every web address you've ever been to. That's how the internet knows how to interpret links. That created the World Wide Web, disrupted all of media, disrupted all of advertising. In 1994, we figured out how to send encoded text over the internet. Before that, anything you typed into the internet streamed for everyone to see. You couldn't put your credit card numbers into the internet. Not surprisingly, in July of 1994, Amazon was founded. It couldn't have been founded in January. It couldn't have been founded in 1993 because it was literally impossible to conduct commerce over the internet. In 1995, we finally figured out how to do voice over the internet. Now we all have VoIP phones. In 2009, we figured out how to stream video over the internet without its buffering. Before 2009, watching videos on the internet was so painful, but we figured it out in something called HLS. The way to think of Bitcoin and all subsequent crypto assets that followed it is that it is the first time we figured out how to move money over the internet. And just like SMTP in the email breakthrough disrupted the Postal Service, and HTTP in the World Wide Web disrupted all of media and advertising, and SSL disrupted all of retail, and VoIP disrupted the telecom industry, and HLS disrupted the video and movie production industry. The reason crypto is up 43 million% in the last 12 years, the reason it's the best performing asset class in 9 out of the last 12 years, the reason it's the best performing asset class this year has nothing to do with this sort of ephemeral idea of an internet coin or token with a funny logo and a name that people aren't familiar with. It has to do that the core underlying breakthrough of crypto-enabled blockchains is the ability to move money over the internet. And money may be the single largest addressable market that the internet has ever served. And it's just starting to do that today. Let's see, I froze there. I would add, people talk a lot about Bitcoin. There are a lot of crypto assets. There's 6,000 or 7,000 crypto assets. I actually think there are 8,000 today. Most of the value is in the top 10, 15, 20. And it's difficult to project which one will win. I encourage you guys to ask me questions. We'll get to the Q&A soon. Happy to talk about individual crypto assets. But just to put it into context, here are the 10 crypto assets in our index, the 10 largest crypto assets that can be held by institution and their returns since November. And you can see there's a wide dispersion of returns between up 1,000% and up, a few percent, less than the S&P 500. This is like any area of technology. There are a lot of people developing new ideas, a lot of people developing new protocols. Each crypto asset does something new. But what unites them is that they're all based on this idea of money and items of financial value moving over the internet. And that's a pretty big deal indeed. Now, I want to run through what's been happening recently because crypto has entered a new phase in 2021. I would encourage you, if you have any questions about what I just talked about, which is sort of the foundation of crypto, what it is, why it matters, enter those questions into the chat. I want to dig into the Q&A. John's going to ask me the hard questions. He loves to put me on the hot seat. If you have like fundamental blockers in your head, don't be polite. If you want to ask me, Matt, how can Bitcoin have any value when it doesn't produce cash flows? Ask away. If you want to ask, won't the government regulate this out of existence? Ask that question. If you have something that's been in your mind, don't be afraid to ask me the hard questions. Those are the ones I want, and they're surely the ones that John will prioritize when he grills me in about 15 minutes. Let's talk a little bit about what's going on in the market right now based on this understanding of what crypto is. Why is crypto at such a hot place right now, right up nearly 100% this year? There are really a small number of catalysts. I would say 4 catalysts that are driving the current interest in crypto. And you should keep these in mind. The 4th one is by far the most important. This one gets a lot of attention. There's rising concerns about inflation. No one knows if we're going to get inflation or not. Anyone who tells you that has more confidence than I do. But what we do know is that there's been a level of quantitative easing and monetary experimentation, the likes of what we have not seen before. And therefore, a lot of investors have increased their concern or widened the tail of potential inflationary outcomes. And therefore, they're looking for hedges. Some people are moving, heavily into equities as a hedge against pending inflation, but a non-trivial amount of people are moving into crypto as a efficient hedge against inflation. And that's, I think, one of the biggest things that's driving folks like Tesla and MicroStrategy and other corporations to allocate to crypto. The second big catalyst, which I hinted at earlier, is this rise of programmable money. This chart is out of date. It now goes above $50 billion. But this is the amount of money that is in this new category called decentralized finance, where people are using software to do things that we used to hire bankers to do, to raise capital, to make markets, to provide insurance, to do loans. Most of that is algorithmic material, and therefore you can do it with software. And when I said that this is the fastest growing industry I've ever seen, you can see this on this chart. In May of last year, this industry barely existed. Today, it's a $50 billion market. People are making multi-$100 million loans. There's an exchange that's trading $70 billion in monthly volume using software. This is a very fast growing space. Excuse me. The third big driver is that supply is lower than it used to be. One way to conceptualize assets like Bitcoin is as a commodity driven by supply and demand. And one of the unique things about crypto is that they're supply inelastic, and actually the amount of new supply being issued for most crypto assets declines over time. So in the case of Bitcoin, the largest crypto asset, about 75% of the market, every 4 years, the amount of new Bitcoin entering the world falls in half. It's called a halving. The most recent halving happened in May of 2020. And historically, there's been a very strong run up in the year to year and a half after halvings. So in 2012, the market rose 100x in the year following the halving. In 2016, the market 29x. This year, it's up significantly. It's actually running ahead of where it did in those examples. I'm not suggesting it will continue, but I am suggesting there is less new supply and it's meeting increasing demand. But by far, the most important driver, what's really happening in crypto is this slide. And if you've studied Silicon Valley, you've probably seen this slide before. It's a slide from Jeffrey Moore's book in 1991 called Crossing the Chasm. And it talks about how every technology goes through this phase of development from the early adopter market to the mainstream market. An example some of you might remember, in the early days of the internet, it was really only used by the military and by kids at university. And then we got email and Google and the Netscape browser, and it hopped into the mainstream. And now everyone uses the internet. Many technologies never leave the early adopter market. Early adopters are willing to work with a technology that's kind of janky, that doesn't work perfectly. An example of a technology that's stuck in that early market phase is virtual reality. We've been hearing about virtual reality for 25 years. The goggles still make most people nauseous. It hasn't crossed over into the mainstream market. The thing that's happening in crypto right now is crypto grew from $0 to $1 trillion by focusing on the early adopter market, right? The people who came first to Bitcoin were cypherpunks and computer scientists and libertarians and anarchists, if we're being honest. And then it entered an early adopter phase where it became a very popular allocation among ultra high net worth individuals in Silicon Valley and other tech centers by tech-friendly investors. And what's happening right now is much faster than even I anticipated. It's leaping into the mainstream market. And the important thing about this slide is almost all of the market is in the mainstream market. 85% of the market is in the mainstream market. And the fact that we're setting records for attendance at presentations like today is indicative of crypto crossing this chasm. So I want you to keep this in mind as I run through some examples. Here's one example. In the last 6 months, we've seen a large number of corporations begin to allocate to crypto on their balance sheets. Tesla bought $1.5 billion in Bitcoin. MicroStrategy's now bought over $1 billion in Bitcoin. Square bought 50 million in Bitcoin. All of these are up hundreds of percent. So Tesla now owns $3 or $4 billion in Bitcoin. This is an S&P 500 company. This is not something that was happening 6 months ago. And it's not just corporations. Hedge funds are allocating. Paul Tudor Jones famously bought Bitcoin as a hedge against inflation in May of 2020. Now, most major macro hedge funds have an allocation to Bitcoin, whether it's Druckenmiller or Ruffer or almost, I would say, probably a majority of hedge funds. Wall Street is also turning towards crypto. JP Morgan in 2017 called Bitcoin a fraud. In 2020, they said the potential long-term upside for Bitcoin is considerable, and they have a whole blockchain division, and they're now recommending it in their flagship research reports. And it's not just corporations and hedge funds and Wall Street, it's also asset managers. Here's BlackRock's CIO, the largest asset manager in the world, saying Bitcoin could replace gold to a large extent and that crypto is here to stay. I want to freeze on this slide just for a second, because if Bitcoin replaced gold from a price perspective, every Bitcoin would have to be worth $500,000. And you have the CIO of the world's largest asset manager saying Bitcoin could do that and that crypto is here to stay. And not only that, but BlackRock is allocating to crypto in 2 of its funds, including its global alternatives funds. And it's not just asset managers and corporations and hedge funds that have moved in the last 6 months. Major technology firms, major fintech firms are rushing into this space. PayPal rolled out the ability to buy Bitcoin and other crypto assets for 200 million US users in November of last year. Those users alone now buy more Bitcoin than is produced every day. They buy more than 100% of all new supply. And this year, PayPal is going to roll out the ability to buy things with crypto at 26 million US retailers. It's hard to contextualize the scale of this, but before PayPal, the largest single provider of access to crypto had 40 million users. PayPal in one day brought in 5 times that number, again, crossing the chasm. To put more context on it, this is that largest provider, Coinbase, now 40 million users. It's a brokerage. It's going public in April at a $90 billion plus or minus valuation. Many in the traditional financial services industry are out of touch with how mainstream crypto has become. Coinbase now has more users than Charles Schwab, TD Ameritrade, E-Trade, and Interactive Brokers combined. And its market capitalization is likely larger than all of those as well. And it's also financial advisors. This is a study we do. We publish it in January of each year, asking about 1,000 financial advisors what they think about crypto. Are they allocating to it in client accounts? And you can see the growth in these numbers. Now, it's still early, but the percentage of advisors we surveyed, again, about 1,000, who allocate in client portfolios is up from 6 to 9% this year. And the percent who plan to allocate in the next 12 months is up from 7 to 17%. In other words, 25%, 26%, more than 250 of the advisors we surveyed said they plan to have an allocation to crypto in client accounts. It's going mainstream rapidly. And this, of course, came out yesterday. Morgan Stanley becoming the first major wirehouse to offer its wealthy clients access to Bitcoin funds. I noted here in their executive summary that some of their decision-making was replicated, was based on the kind of study that we did in the CFA Institute guide that we mentioned earlier. All of these new entrants to the market are looking to allocate into this space, and they're coming up against inelastic supply. Unlike traditional commodities, it is not the case that the more people want Bitcoin, Ethereum, or other assets, the more of those assets there will be. The supply is algorithmic, programmed, and actually tends to decline over time. So if you want a really simple way to contextualize why the bull market over the last 6 months, it's that you have an entire new class of investors, corporations, hedge funds, asset managers, wirehouses, financial advisors, PayPal users, other retail users coming into a market with inelastic supply, and that's driving the price up. I think this mainstreaming of traditional mainline crypto assets is here to stay and only accelerating. We're almost at the time I wanted to reserve for questions, so I'm going to go quickly through this last section, 3 slides, crypto in a portfolio. The thing I want you to think about when you think about crypto in a portfolio is that it can be extremely powerful in portfolio settings, and it's a little bit like cayenne pepper. A little goes a long way. And it actually has a really unique characteristic for people who are looking for something to diversify stocks and bonds in today's environment, which is that crypto combines really 4 things that are hard to find in any single asset. It has high potential returns. We covered that, up 5,000% over the last 4 years. It has low correlations to other assets. I've put here the correlations to the S&P, the ag, and gold. They tend to be 0.1 or 0.2, depending on what time period you look at. And unlike most things that are high return, low correlation, things like venture capital investments or PE investments, crypto is liquid. It's intraday liquid, in fact, but it's liquid and it's accessible. We have endowments in our fund and we have retail investors in our fund, and they buy the exact same exposure. Unlike venture capital and PE, where the best allocations go to the largest investors, crypto is this unique alternative asset that's open to everyone on an equal basis and can provide those high returns and low correlations. The effect of high returns and low correlation is that if you put it in a portfolio context and you have a rebalancing frequency or a rebalancing tolerance, it can have this salutary effect, at least historically. This is a slide that looks at the impact on a traditional 60-40 stock and bond portfolio, the most plain vanilla portfolio in the world. 60% all world stocks, 40% all world bonds for the 4 years ending in December 2020. This is before Bitcoin went up another 100% or so. And what I'd look at is, say, that 2.5% line. Just a small allocation to crypto in a portfolio, 2.5%, increased the portfolio's return from 50% to 76%. The volatility barely budged from 11.6 to 12%, and the maximum drawdown barely moved as well, 21.1 to 21.8. It's despite being incredibly volatile as an asset itself, when you put it in a portfolio context and manage it appropriately with a rebalancing tolerance, it has this ability historically to increase returns without significantly increasing volatility. Of course, past performance is no guarantee of future returns. I'm sure we'll have questions about that, but I'd add this slide, which takes a different look at that same analysis. So this is my last slide. It's a rolling return slide. So what this chart is looking at is the rolling returns of that 60-40 portfolio in the black line. That every dot on that line represents the culmination of 3 years of returns. So the way to look at the dot on the far left is that the 3-year returns of a 60-40 portfolio for the 3 years ending January 1st, 2017 was about 10%. And all the way to the right, it's the 3 years ending December 31st, 2020. And the green is the impact that adding a 2.5% allocation to a portfolio would have had over that period. The takeaway of this slide is there's never been a 3-year period in Bitcoin's history where adding it to a portfolio with a rebalancing strategy didn't boost your cumulative returns. If you shrink that to a 2-year window, the win rate is about 94%. If you shrink it to a 1-year window, the win rate is about 79%. It's a long-term allocation, but it has had this strong historical positive impact because of its ability to combine high potential returns, low correlations, and liquidity and access. I'm not here to say it's not without risk. It's without huge risk. It's with huge risk. That's why we're talking about very small allocations. There's regulatory risk, technological risk, adoption risk. The list can go on. We can dig into those risks in the Q&A. But what I want you to take away from this presentation really is 2 things. When you think about crypto, don't think of it as a new currency you're going to buy your coffee with. You'll be disappointed with that view. Think of it as a technology that allows money to move over the internet, that allows us to have digital property rights, that allows us to program money like software. That's the reason it's had those high potential returns, and that's the reason it's delivered low correlations to other assets. And it's at least worth educating yourself about the space and the risks and the opportunities. And with that, John, I'm going to click through my disclosures, turn it back to you, and I'll try to end my screen share, and we'll just talk for a little bit. Let's dig into the Q&A.
Amazing, Matt. Great job compiling some of the questions here. I think due to time, I'm going to try to group some of these together so that we can try to answer as many as possible. And I'm going to start with what seems to be the most common question in the chat. It's around the halving, mining, who gets paid in those transaction costs when you send money. You had mentioned the 57 cents. What happens when all of those coins are mined in a handful of years? And then obviously a topic that's come up more frequently recently is the energy impact of that mining, computing power. Is it green? Is it not green?
Great questions. I think I can tackle them all pretty quickly. So I love it. Just to lay the groundwork for everyone who doesn't know, if you think of what a bank does, it processes your transaction, it makes sure it's valid, and it adds it to its database. Crypto miners are a group of distributed computers, anyone can do this, that compete to do the same thing on the Bitcoin network. So these are the people who are maintaining the database and processing transactions and making sure that it follows the rules and that money moves from one person who owns it to another person that owns it. These miners are rewarded in 2 ways. So the first way they're rewarded is every time they process a batch of transactions, they're given a grant of a crypto asset. So in the case of Bitcoin, when they process a block of transactions, which takes place every 10 minutes, they get 6.5 Bitcoin as a reward. That's a lot of money, right? At current prices, that's like, what is that? $400,000. They can also, there's also a way, if you're trying to send money, to add a tip that tells the miners to prioritize processing your transaction. So when I said that the $1 billion transaction had a fee of 57 cents, what I meant is that they appended a tip to that transaction of 57 cents, and the miner who won that transaction also got that. So miners get paid in 2 ways: new issuance plus tips. What the halving means is that every 4 years, the amount of that new issuance you get falls in half by count, not by value. But before this most recent halving, you got 12 and a half. Now you get 6 and a quarter, or I actually have that backwards. But down the road, you'll get 3.125, and then so on and so forth. So you get less and less Bitcoin every 4 years. The answer is the last Bitcoin will be issued in 2140, so 119 years from now. So you have to have a very long-term view to worry about what happens when we've run out of Bitcoin. But the answer of what will happen is that over time, the amount that's represented by those tips will increase, and the amount that's represented by the issuance will decrease, so that the miners are still appropriately compensated for maintaining the database. Again, it's a long way out. That's a process that'll happen, hundreds of years from now. It'll still be cheaper than the traditional financial system. At least that's the expectation, is that tip revenue will be very low relative to the size of what's being processed. Now, the environmental question is very real. So I could give you the traditional crypto line, which is that most of the mining activity happens near renewable energy sources and places that have excess energy that would otherwise be wasted. And that is true. But it's absolutely true that Bitcoin consumes a lot of energy. And if you think it's not a useful thing to have this new internet of money, then you assume that energy is wasted. If you think this is actually a valuable thing, you can argue about whether that energy use is valuable enough. I'd add one more interesting thing for you. One of the reasons I'm so bullish on index-based strategy, and remember the funds Bitwise offers are index-based funds, is that different crypto assets are competing in part on this environmental question. So the second largest crypto asset, Ethereum, is actually moving to a new way of confirming transactions that doesn't consume any energy. So one of the reasons I like the index-based strategy is that Bitcoin is the most secure developed blockchain in the world. I think it probably has a lock on digital gold, but there's a non-zero chance that these environmental concerns become so large that people look to migrate to a carbon neutral alternative. And one of the things you get in an index strategy is the second largest asset, which is competing in part on being that carbon neutral alternative. So it's early days, and it'll be interesting to see how it turns out.
My gosh, Matt, no better bridge to the next couple of questions. So you had mentioned Ethereum. Let's start with Bitcoin versus gold. One of the questions that came up is determining value of Bitcoin. You can continue to refer to the gold market. So how do you value Bitcoin? And then again, compare it to gold. And then what are the other tokens out there like Ethereum? Why is Ethereum doing something different to Bitcoin if they're using similar protocols, or are they using similar protocols?
Such a great question. We addressed this in the CFA guide that the ways to value crypto assets are currently disappointing and not perfectly developed. So I think we'll get better over time, but this is a new asset class. Bitcoin doesn't create cash flows. You can't do DCF analysis on it. It's more like a commodity like gold. I think Bitcoin's primary use in the world is as a non-sovereign store of value that competes with gold. I would argue it's better than gold at most things. It's more transportable, it's more divisible, it's easier to store, it's harder to counterfeit. It doesn't have as long a track record, but I think it can compete in that market. So one thing that a lot of people do to think about what the price of Bitcoin should be is that they look at the market for gold, which is about a $12 trillion market, and they look at the market for Bitcoin, which is a $1 trillion market or say, and they say, do you think Bitcoin will have 10% of the non-sovereign store of value market? Do you think it will have 50% of the market? Do you think it will grow that market? And there are a lot of people who think the steady state for the primary digital alternative to gold is not to be 3, 4, 5, 6% of the market, but to be 50% of the market. And if that's true, Bitcoin will be worth 5x what it is today. And then you can start to talk about, can it penetrate these other use cases like a tool for international settlement or a global version of money, et cetera. And you can start to stack addressable markets on top of it. Now, the Ethereum question is one of my favorite questions. And here's how I answer it. Bitcoin was the first blockchain. All blockchains are software-based. And the first blockchain was very simple software. In a literal sense, it was like 300 lines of code. All you can program Bitcoin to do is to send value, receive value, hold value, or destroy a Bitcoin, and a few very elementary programming techniques. It's kind of like a calculator. Ethereum was the second major crypto asset developed, And it was inspired by Bitcoin. They looked at Bitcoin and thought this Internet of Money thing is very cool. But what if we could program it in the same way we program a computer? So the Ethereum blockchain can be programmed to do anything. In other words, it's what's called Turing complete. You can program it to do literally anything the same way you can program a computer or a website, etc. Now, you might be thinking to yourself, Matt, doing everything is better than doing some things. So why is Ethereum a quarter or a tenth or a fifth of the value of Bitcoin? And the answer to that is actually a little bit surprising. In the world of cybersecurity, the less your software can do and the smaller the lines of code you have, the more secure your database is. The less likely you're going to have a bug. The less frequently you update that code, the more secure you are. So Bitcoin is actually extraordinarily good at storing value. And the reason people talk about it primarily as a non-sovereign store of value is that that's what it's good at. Now, Ethereum, you can program to do many more things. You can program to serve as an escrow agent. You can program it to serve as a lending agent. You can program it to build a competitor to the New York Stock Exchange. People are doing all those things. But because it's so much more programmable and because it's evolving more quickly, it's riskier. It's not as secure. So it sacrifices security in order to do more. As you go down the chain to other crypto assets, they're each specializing in different areas. They're crypto assets that are much faster than Bitcoin or Ethereum. They're crypto assets that do individual things really well, but can't do everything else. They're crypto assets that have unique governance mechanisms. It's like any area of software, right? Oracle, Microsoft, and Salesforce are all great software companies, but they're all optimized to do different things. And one of the reasons I love index strategies, again, as opposed to a Bitcoin only position, and I love Bitcoin, is because I don't know which application in this idea of moving money over the internet is going to be the biggest. And so like any area of finance, these aren't fungible assets. They do different things well. And that's why you see that wide dispersion of returns that I showed you, with some assets up 1,000%, some assets up 20%. They're going after different markets and they're succeeding at different rates.
Amazing. I know we're getting close to the top of the hour, so I just want to remind everyone before we start seeing people drop off. If you were looking for the presentation, we're happy to send you a copy of that. If you're looking for more information or want to talk through some additional talking points, please again, reach out to Megan or Mark. They've got my contact information. Matt and I could do some follow-up. But I want to make sure we get to the last kind of segment, last question that a lot of people are posing questions around is the access, right? We've talked about some of the private placement that Bitwise has, but obviously everyone has their eyeballs on an ETF, Matt. And with your extensive background and a Lifetime Achievement Award nominee in the ETF space, what are your thoughts about a Bitcoin ETF? When do you think that's going to come? And what do you think you see around that?
Yeah, that's a great question. I think about it every day. It's one of the reasons I joined Bitwise. Look, eventually we're going to get an ETF. Canada has an ETF, Europe has an ETF, Switzerland has ETFs. We're getting much closer than we were a year ago, 2 years ago, 3 years ago, et cetera. We've been in constant dialogue with the SEC. I had 13 meetings with the SEC last year. Most of those meetings had 20 to 30 people on it. They're digging into these questions very carefully. I would not be surprised if we saw an ETF by the end of this year. I would not be surprised if it was early the following year. I would be surprised if we're talking about 2023. I think we're closer than that. And the question investors have to ask themselves is, do they want to wait until there's an ETF that's very easy to access, trades at NAV, is available in brokerage accounts, settles in advisor custodians to access this market? Or do they want to access it before that ETF comes to market in one of the vehicles that's available today? Whether if you're investing a few $100, that's like Coinbase app on your phone, or if you're making a more serious investment, it's a private placement or an OTC traded security like BITW, which trades at premiums and can trade at volatile premiums. You have to decide yourself, is it better to wait until there's an ETF that makes it very easy, or is it better to get ahead of it by working with these less perfect products? But I do think we're going to get there. All the regulatory tea leaves are pointing in that direction. And it'll be an exciting day when we can get there. I just add one more thing to think about. The ETF will be Bitcoin only. It'll be many years until the SEC approves a diversified approach. And I just remind people to think of that slide with 1,000% dispersion of returns between the top crypto assets, that Bitcoin is just one piece of this ecosystem. It's the entree, it's the largest asset, it's the most developed, but there's a lot of exciting things going on behind the scenes as well.
Amazing. Matt, thank you again. Always a great job. Love listening to you, even though I get to hear you all the time. I still enjoy it. So I'm going to hand it back to Mark.
And I'm simply going to say thank you both for just a wonderful session. I know we didn't get to all of the questions. We'll see what we can do about that, and sharing the slide deck and all of that. And again, thank you everybody for putting up with the technical difficulties at the beginning of this. I think we figured out what the secret is to a hybrid event. So we're looking forward to the day when we can see some of you, more of you, face to face, and still allow for people to attend from the four corners of the globe as they did today. So again, thank you everybody, and stay safe, and we'll see you at an upcoming event. Take care.
Thank you again.
Thanks,
Bye.
everybody.